Hi, everyone. Today, I'd like to help you answer the question, what type of business are you really building? There's a saying in startup circles that companies are bought, not sold. And for venture scale outcomes, that's often true. But that doesn't leave a lot of control for founders to control the timing and the terms of their outcome. In our case, my founder and I were able to sell our business, not in a lightning strike acquisition, but in a deliberate banker-led process. We sold the business for tens of millions of dollars when we controlled the majority of the business, and we were only able to do that because we understood what type of business we were building and adapted along the way. Most business advice focuses on the extremes. On the one end, you have small businesses like your local coffee shop or agencies where they have stable but limited growth. And on the other end, you have huge, or rather venture scale businesses going after huge markets in the billions of dollars of TAM that require rapid fire fundraising. I believe there's a category of businesses in the middle that are often overlooked, but can have the most repeatable and often have the most founder-friendly outcomes. I call these growth businesses. A growth business is a business that has good but not extreme growth at scale. Think 20 to 30% year over year to up to 100% year over year growth when you have millions or in the low tens of millions of annual recurring revenue. These businesses are close to profitable. They don't need to be in the black today, but they have a path to get there. They're lightly capitalized and typically founder-controlled, meaning you've typically raised less than 10 million. And underlining all of this is that you're typically building in a business in a large but not huge market. Think hundreds of millions of TAM, not billions, where you need the venture capital model to grow at all cost. The trouble that founders get themselves into is that in the early days, it can be nearly impossible to know what type of business you're building. You raise aggressively and you hit initial traction. The issue is that ceilings, or rather markets can have ceilings. And if your growth slows and you continue to apply the venture capital model, you'll believe that the only solution is to raise more. The issue with that is that if growth is slowing, your revenue multiple is compressing, and any additional capital you raise is eating away at your founder equity. There is another path. The early stages are the same. You believe in a huge market, you go out and raise, but when growth slows, you pivot. You stop fundraising or raise less. You focus in on operational efficiencies. And while the growth and exit may take longer, by the time you get there, you've preserved your founder equity. This is the path that my co-founder and I took, and it led to a life-changing outcome for us. There are pros and cons to building these types of businesses. As I just mentioned, of course, they can be very financially rewarding for the founders. I also think once you hit scale, these become very predictable in terms of their outcomes and valuations. And there are a huge pool of serious buyers that want to buy these types of businesses. On the flip side, it's unlikely that early investors or employees of these businesses will make life-changing money. They require you to be more disciplined, and you have to be comfortable with saying no. And of course, they're less flashy. In sum, you should continue to ask yourself the question, given my market, my growth rate, and my goals, am I building a venture scale business or a growth company? The answer to that question may change, but if you're honest about it and adapt, you can preserve your equity, control your outcome, and build a business that will truly reward you. Thank you.
Hello, thank you for the small talk. It was really informative. How did you sort of maintain clarity when going through your startup phase and, like you said, being honest with yourself?
It's tough to answer because that was probably the biggest fight that me and my co-founder ever had, was we had a group, or rather a group partner session at Y Combinator, and I said that I don't think this is a billion-dollar company anymore. And after that chat, my co-founder called me and basically screamed, how could I not believe that's the case anymore? Um, so other than just continuing to reevaluate and ask that question and hopefully being honest, and I wouldn't advise, if your co-founder has that feeling, like, talk about it, don't scream at them.
I'll jump here for next one. So you said you sold a business. Sound like you had bankers. So what was your process when you knew you wanted to sell? What steps did you take?
So first, I think you need to have a business that makes sense to hire a banker. We're talking at the small end, tens of millions in equity value for a banker to make sense. Typically, if you're at this scale, the bankers will know about you, and you'll have had plenty of bankers reach out. They can waste your time if you're not ready to sell, so you should just be saving those contacts. You can then reach out to communities, like if you're in Y Combinator, in the Y Combinator community, or to find references for other bankers, and then you can run a bake-off, that's called in the industry, and have these banks pitch to you, tell you their process and why they're the best. They're pretty similar across the banks, so it ends up tending to be a lot more who you feel you fit with the best. But from there, it's a very standard process that they'll run you through. They'll build some presentation materials that they'll send out to potential buyers. They'll sign NDAs. You'll pitch to the buyers. The buyers will submit their initial bids. You down select from there. You meet in more depth with those buyers. They submit a second round of bids. You select your preferred buyer, and then you work with them through to sale.
One question from the back.
Hey, thank you for the talk. Where does a debt facility fit in those diagrams? And when would you leverage debt over equity raises?
I think it really depends on the business model. We did not use any debt, so I don't have any deep expertise in here. Yeah, I don't want to answer that question because I don't know. We didn't use debt, so.
Sounds good. Thank you.
Thank you.